they're not in the business of coming in and taking over the show because they don't have time for that. The reason they're partnering up with someone is because they want them to drive. They want them to drive the business plan. They don't want to come in and just take over. That's not to their advantage.
You've probably heard the term institutional investor before, but do you know what it means? This type of investor has long been shrouded in mystery and controversy. Some investors love them, others refuse to work with them. Today we're bringing on private equity expert John Azar, founder of Peak 15 Capital, to debunk some misconceptions about institutional capital and also peel back the curtain on this sector of the real estate space that has long been misunderstood. Here we go. You work with private equity and institutional groups, and that's really the main topic, the main theme I wanted to dive into today. You serve as the bridge between sponsors and their deals and these private equity institutional capital groups. But a lot of people, I think that private equity is a buzzword in this space. So I really appreciate it. Just to start out, can you define what is a private equity group?
A private equity group, I mean, and we are a private equity group. I mean, private equity group is anybody who would essentially bring their own allocated capital, whether it's in-house or through a fund, to other people's deals and fund them, and then take essentially either participate in a deal as a partner or participate in a deal as a limited partner or as a full general partner, and essentially be able to kind of structure some kind of a partnership through the capital stack. So I mean, they're most private equity shops are really are capital allocators. That's really what they are, and that's really what we are in a very simplistic way. We play in the capital market space, which means one of the value that we bring is capital to the table and capital solutions. But that is not all that private equity brings to the table. That's why I was careful to say one of the things that we bring to the table is capital, because a lot of time people have the misconception that a private equity shop is just all about money. It's just all about what kind of check or the checks that they bring to the table. And that's not true. Sometimes, a lot of times, in fact, the best sort of private equity companies out there are bringing to the table more than just money. They're bringing to the table expertise. They're bringing to the table collaboration. They're bringing to the table other factors of the transaction that is needed, whether it's from a balance sheet perspective or experience perspective or operational perspective sometimes. So it just depends. And then money obviously is a big, probably the over dominant portion of what they're bringing. But obviously it all starts and ends with money and what you can bring to the table. But it's not it's certainly not the only factor that identifies and certainly brings to the table from private equity shops. So yeah, I mean, so it's a really sort of a diverse offering that private equity companies bring to the table, but mainly it is capital.
Yeah, absolutely. I'm glad you really clarified that because I think there is some misunderstandings regarding the role of a private equity group. Now, I also know you work with institutional investors, and I think that might be maybe where we want to take the conversation. But can you clarify the difference between an institutional investor and the private equity group? It seems like the private equity is the umbrella, and an institutional investor might be under that umbrella. But can you expand on what is an institutional investor?
Yeah. There's no. I mean, you're right. You're right. Private equity is kind of an umbrella, or maybe even institutional equity. Sometimes people think of institutional equity as as hedge funds or pension funds or something like that, and that is correct. I mean, in a lot of institutional equity is the word institution really comes from the standpoint of a capital source that is being driven by some kind of a committee, an institutional committee of some sort that makes the decision on where to allocate capital and how to allocate capital. And that usually is found in larger shops that allocate capital into varying sectors, not just commercial real estate. So institutional capital could be BlackRocks of the world. That's on a sort of somewhat of a larger scale, or Goldman Sachs, or KKR, something like that. And these are huge, large institutional shops. But it could also be pension funds. It could be endowments. It could be university endowments or state employee pension funds. Or also on the smaller end, it could be institutional. It could be private equity shops that have a discretionary fund that they allocate capital out of for certain deals. So indirectly, I guess we fall under that guise of the evil institutional world. But I'd like to think that we don't. But and I'd like to think that it's not an evil world necessarily. It's just a name. That's all. It's just an umbrella that people like to lump all kinds of companies under.
100%. And that's such an important distinction because I think these institutional groups, we're going to get into like a lot of the misconceptions involving them, but you obviously work with these groups in your real estate business. And as a result of that, I imagine you have to really understand how they think and how they approach their own real estate investments in order to really facilitate those, that connection between the deals and those groups. So to start off, I mean, in general, I know this is going to be a very broad, encompassing question, but how do private equity firms or specifically institutional groups, how do they analyze and assess potential real estate investments differently from individual investors or smaller investment groups, if there is any difference?
Well, I mean, if you're referring to smaller investors, meaning like the retail investors, completely different. I mean, it's not the same. It's not in the same ballpark of how they assess investments. I mean, retail investors depend on and they also vary in sophistication. One retail investor, not all retail investors are created equal. I mean, retail investors that, if you take one retail investor who invested in a particular sector and have knowledge on it, such as because we deal with retail investors, high net worth investors as well for our fund, because that's who we raise money from for our fund, for our co-GP fund. So a retail investor that have invested in syndications, retail syndications in particular, and have knowledge of how real estate space work and what how money is being made in the in the real estate space or multifamily space in particular, is going to be completely different from a retail investor who has never invested in anything like that, who's only invested maybe in stocks and bonds, or just put their money in a mutual fund, and now they heard about real estate and they just want to kind of explore it. So I mean, even among retail investors, those two investors are completely different and a completely different set of expectations. And then you take on the institutional investors. I mean, that's a completely different animal altogether, because that's the set of expectations are completely different. There's got to be a lot more sort of alignment. There's got to be a lot more, and when I say alignment, meaning alignment of interest, of when the deal does better or performs better, that their money is performing better, and as well as the relationship as a whole is performing better. Some of the best institutional investors approach their relationship that way, approach their relationship as mutually beneficial and mutually profitable to both parties involved. But they also have their metrics they have to meet. Institutional investors are driven by their own sort of mandates that they have within their companies. They have, it's not just that's one of the main differences between them and a retail investor. Retail investors could be just assessing what he or she may or may not need for their money and what they want their money to do. Institutional investors are oftentimes are representatives from what their company's mandate or fund mandates dictate them to have to deliver. So they have very strict guidelines on what they need and what they don't need. They're not trying to be difficult, but that's just the mandate of their company. So, if their company mandates that they can't invest anything under $10 million, for instance, that's just how they are. It's not like they're being picky. That's just the mandate. If their mandate is they can't invest in self storage. They can only invest in multifamily. That's what they have to do. If they can't, if their mandate is they have to achieve, over 15% IRR returns, otherwise it's a no go. That's what they have to do. So I mean, there's a lot of metrics that they have to abide by. That is being mandated by their sort of either investment committee or sort of the investment mandates that sit in place for them, as opposed to a retail investors who's just really just kind of trying to assess whether this is going to work for him and his family personally, and kind of preserve their wealth and assess what the risks are and see what the returns are going to be for them.
I'm aware that it's obviously becoming more and more apparent that there is a big difference between these two types of investors. And the goal of this conversation, I would say, is to at least put a dent in that like sort of mystery shrouding the institutional capital space. Personally, we're always hearing about retail investors and how they think, how they approach investments, but I don't know if there's as much information out there on these institutional groups. So I really want to, yeah, go ahead.
Well, I was going to say one word to differentiate would be, think of institutional investors as more partners than investors. Retail investors are investors. They're true investors because they're really putting their money to work, and they're just, they're depending on you for the knowledge and the safety and the drive of the business plan and all that kind of stuff. So institutional investors are not that way. Institutional investors, when they put their money to work, they're really partnering with you. Yes, they are depending on you also still to drive the business plan forward, but they have their own set of demands and criteria, and they have their own sort of sense of reporting. And they are going to demand a lot out of that relationship, as a true partnership should, as opposed to a retail investor. So
Yeah, no, that's awesome, man. And so let's maybe, instead of talking about like retail investors, let's maybe take the angle of the operator sponsor, because maybe that's more focused. Like they might have their own access to their own pool of retail investors, whereas the institutional group has their own funds, or unless they have their own investors, which you can probably provide more clarity on. I did want to expand on the due diligence process. Is it the same for a normal syndication operator sponsor team as it is with the institutional group, or are there any drastic differences in that process? And one thing I did want to kind of tie on to that is there is this general sentiment regarding investor philosophy when it comes to investing in real estate, the preservation of or just investing in general, the their motive about preserving capital and how that's more of a priority over making a profit and like the excitement they get. So they're more fearful of losing money than the excitement they get towards making money. And so to kind of tie on to that, how do these larger groups tend to balance that desire to make a profit and also preserve capital?
Uh, well, they balance it out by doing a lot deeper due diligence on the sponsor and on the deal itself. So they balance that by making sure that the deal is meeting the sort of the profit projections that they expect, that they have, that it's hitting all the metrics that they kind of lay down as far as what they expect out of the deal, from a performance standpoint. So yeah, I mean, capital preservation is certainly, I mean, that should be universal for everybody. That should be universal for retail investors. Nobody's going to go into an investment thinking, oh, you know what, I can lose this. It's fine. I mean, it's, that's not, that's, if that's how only people who go to Vegas do that. I mean, this is not an investment, a real estate investment should not be a gamble. If you know what you're doing, if you're not, I mean, there's a certain amount of risk, obviously. It's not a riskless investment by any chance, and that's one of the first thing I tell a lot of my, even retail investors when when I'm asked as to, what is the worst case scenario. Well, the worst case scenario is you lose your money. I mean, that is true. I mean, if you have to be honest with everybody, that is the worst case scenario. But how you do that, there has to be a certain amount of like certain disasters that happen in your operations and in the economy as a whole in order for an investment to be lost completely. So there are a lot of safeguards and a lot of things that could be done, and so you can start at the worst case scenario and then work kind of reverse engineer it back. Like, okay, that is the worst case scenario, but let's kind of backtrack it a bit. In order for that to happen, all these horrific things have to occur, and they've never occurred with me, or they've never occurred with my team. This has kind of been the performance, so that's how you kind of tackle that. But in terms of capital preservation and capital growth, I mean, they should be hand in hand in everything. I mean, everything, capital preservation should be a no brainer for. I mean, that should be like obviously we are in this industry to preserve capital. So that should be a given. Capital growth, that's going to be a whole different sort of calculus and structure itself to see how and in what way you're going to be able to grow and achieve the kind of returns that you're expecting it to achieve, while maintaining the correct assumptions, while maintaining the correct patterns, while maintaining the correct guidelines as to how you're managing your investments. I mean, half the battle is actually buying something right, and then the other half of the battle is managing it right until you actually sell it on the other end.
I think that is very apparent, and it's almost, it should be obvious, right, that the investors are motivated to preserve their capital. And I just kind of figured that since they have so much more capital, that it's obviously they're taking more risk. And so you did touch on it regarding like their due diligence is more extensive.
Yeah, I mean, a lot of institutional investors depends where they come from, especially like so these days, especially overseas investors, European investors, Asian investors. They have a lot lower threshold of returns than American investors, North American investors, meaning like their return expectations are a lot lower. The capital preservation need is still there, But there's a big difference from someone, coming from a country that is really in a not a good economic situation. They're not offering them a huge amount of, they can't make a huge economic interest or economic upside there. They're coming to the U.S. and they have an expectation of, if they're able to achieve 5-6% IRR, they're happy. Whereas opposed to some other maybe domestic national, U.S. based investors, institutional investors, they have to achieve double that, if not more, for that to make sense for them. So it really it all depends on your return expectations, and that's really what differentiates people and that's really what differentiates people when they get into a deal bidding situation, and how somebody loses a deal to somebody else, because a lot of times, people come to the table with the numbers. The numbers are the numbers. At the end of the day, if you calculate the deal right and underwrite it correctly, which, that should be the first step, is underwrite a deal correctly and have the right assumption and have the right growth pattern. At the end of the day, the numbers are the numbers. What makes a difference is how someone wins out over someone else is what their return expectations are. If my return expectations on a deal is, 15% IRR, and somebody else's return expectation with the same exact numbers is 10% IRR, they're going to win the deal over me any day, because I can't dip down low enough to get below that 15% IRR.
Yeah, and that brings up another point in my mind where there seems to be two schools of thought right now where there obviously there isn't the bid ask gap we're seeing right now between where buyers are able to buy and sellers are willing to sell for. And I think that's resulting in a lot of capital on the sidelines. And that there's been this sentiment where there's going to be a massive wave of opportunity coming, and other people are saying there's a lot of capital on the sidelines, so that's going to reduce the real opportunity that's going to be coming once it does unleash itself on the market. And I wonder, how do these larger institutional groups, how do they how are they navigating the competition in the market? Do they even have to compete for deals, or is it the fact that they have so much capital? Does that kind of allow them to throw their weight around and get into opportunities whenever they want?
Oh no, they have to compete. I mean, they have to compete like anybody else. I mean, especially on good deals and deals that make sense. Yeah, I mean, make no mistake. I mean, not everybody holds all the cards. So, just because, again, remember what I said in the beginning, it's not just all about money. Money makes a huge difference, and who cuts the check makes a difference. But that's not the only thing that differentiates them. Relationships are key, and what is bringing, everything else holistically that's being brought to the table is key. If I have, even if for deals that we do, if I have two sets of institutional investor, one guy is bringing money to the table and the other guy's bringing this, they're both bringing the exact same kind of money to the table. And one guy has a much better relationship with me, is great to work with, has a fantastic team. We are very comfortable together. They also are bringing, they're bringing expertise to the table, because we think they're going to be a great partner. The other guy's just bringing money, and he's like, well, I'm just going to cut a check for you. And, I'm not going to bring anything else to the table. I'm probably going to go with the first guy. I'm definitely going to go with the first guy, because, it's exact same money, but I'm going to go with somebody who brings a little bit more value than just the check they're writing. So yeah, there was absolutely, on good deals and on deals that are, um, that are competitively priced well and generate the right kind of returns. You could have some competition out there from institutional investors. So they're not just because they have the money doesn't mean that they have all the power.
And I want to dig a little deeper into how these groups think, if you don't mind. I want to know from their perspective, what factors contribute to the success of a real estate deal, maybe particularly a multifamily syndication deal?
I mean, factors of success are again varying. I mean, depends what their expectations are. If they're achieving the right type of returns, if you got to understand. First of all, you got to understand what is most important to them. Is cash flow more important to them, or is kind of deal multiples more important to them? Is IRR more important to them? So they all have different sort of levers of what is priority when they get into a deal. And you have to understand that before you position your deal, or if you want to position your deal correctly, because you could be pitching, well, this deal has amazing cash on cash story, but the IRR is not as good, and you don't know, and if the person you're talking to doesn't really care about cash on cash, but they care about IRR, you just lost that investor. Or if you're talking to an investor and you're pitching him, IRR, 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 like, yeah, it's going to be great. It's going to generate, 20% IRR. And he doesn't really care about that. He just wants the cash flow. They just want to make sure that this deal is generating enough cash flow annually. They don't really care about the IRR. Again, you're kind of barking up the wrong tree. So you got to make sure that you're positioning the deal correctly, which and that only comes from asking the right questions. That yeah, and that's you got to ask questions. You got to ask questions in order for you to get to see what your audience are and what they're expecting. I mean, heck, it's a lesson I had to, I'm having to relearn all the time now that we through our fund and we're talking to retail investors. In fact, I just recently told my team, listen, just stop me when I'm presenting to retail investors, because I tend to almost speak the same way as I'm speaking to you now, or I'm speaking to a lot of our institutional investors, to retail investors, and it's sometimes a lot of times they glaze over, and I have to stop and take a step backward and start to ask a lot more questions as to what do you know, what are you comfortable with, what kind of stuff can I explain, what are the concepts that you're familiar with. That's for retail investors. So for institutional investors, you got to ask also very similar, the right questions. What kind of returns expectations do you have? Where do how do you calculate returns? How do you calculate the validity of the deal? What is the most value in a deal for you? What makes a deal more valuable? How do we grow together? Is this going to be a programmatic approach or non-programmatic approach? Are you more transactional or are you more relationship driven? So you got to understand all of that before you kind of even see if how the deal is going to make sense and what they're going to expect out of you and the deal.
Yeah, there seems to be, because I know they're very different, retail investor and the institutional partner. But there seems to be some overlap in the way they think, and it's just on a bigger scale, maybe. But earlier, you did draw that distinction between calling in institutional groups investors or versus a partner. And so I wanted to know, and I know it can probably vary, but what ways do they, or what approach do they take to structuring those partnerships? And if it might be easier to kind of give us an example of how maybe the partnership might work in terms of structure, that'd be great.
Yeah, I mean, they typically come in they could come in as limited partners, or they can come in as joint venture partner or co-GP partners. So there's two ways they would come into the table. But even if they come in, even if an institutional investor comes to the table as a limited partner, which a lot of groups do, even as limited partners, they're not the same kind of limited partners as retail investors. Retail investors, when they come into a deal as limited partners, they really have, I mean, they don't have any say so in the deals necessarily. They have no, they can't necessarily tell you what to do and what not to do and how to run the operation. Whereas institutional limited partners, LPs, even though they're technically limited partners, they have certain control provisions that they come in with that they have to sign off on, which is natural. I mean, and I'm always surprised when I say this to some of the operators and sponsors out there, and they're like, "Well, what kind of control provisions?" I'm like, "Well, what do you expect when somebody's giving you 90% of your equity and giving you a check for 90% of your equity? If they're bringing 90% of the money, did you expect to just be, scot free and not have to be answerable to anything? Like that's not reasonable." So, if somebody's bringing 90% of the money to the table, they're going to have certain provisions that they're going to want you to perform. They're going to either have certain performance metrics, or and they're also probably going to have some certain voting rights on the deal. They're going to have some kind of buy sell provisions. They're going to have some kind of voting right or control right on when to sell, how to sell, and what kind of metric to use on that. So just because they're limited partners from an institutional side doesn't mean that they have no say so on things. In fact, it's the exact opposite. They generally comes with a lot of kind of covenants and control covenant provisions that gives them certain amount of comfort and ability to kind of pull the trigger on certain things in a deal.
Yeah, that's funny because I've heard a lot of horror stories. Not a lot, but I've heard a few horror stories about sponsors working with institutional partners, and I think that's led to some misconceptions regarding how you work with an institutional group, and a lot of people just choose not to even work with them at all. I wanted to have you maybe address that. Are there any misconceptions that you're aware of regarding institutional capital and bringing them on as a partner, and are any of them valid or correct?
Yeah, look, I mean, yeah, some of them are valid, some of them are incorrect. Some of the misconceptions out there are is that institutional partners want to come in and just take over the show. That's not what they want to do. That's not to their. They're not in the business of coming in and taking over the show because that's not. They don't have time for that. The reason they're partnering up with someone with a sponsor or syndicator is because they want them to drive. They want them to drive the business plan. The reason they invested and agreed to invest with someone is because they believe in their vision. They believe in the way they operate an asset. They believe in the story of that asset and how they can grow it and how they can manage it for them. They don't want to come in and just take over. I mean, that's not to their advantage. The other misconception is that everybody they'll write they'll come in and write a check and like not bother you or something like that. And that's also a misconception because if somebody, I just said earlier, if somebody's coming in and writing you an 80-90% of the money check, they're going to have some certain rights and certain provision that you're going to have to provide. You're going to have to give them more updates. You're going to have to give them more, keep them updated with what's going on with your asset and their property. So there's certain controls with that. Some of the conceptions out there, as far as like what you mentioned, horror stories of institutional investors maybe walking away from a deal or walking away at the 12th hour, or it happens. Yes, I'm not going to say it doesn't happen. Of course, it happens. But you have to make sure that you work with the right partners. You have to make sure you ask the right questions. You have to make sure you have a backup plan. You have to make sure that you're not leaving things to the 12th hour, obviously. And you got to be prepared. Preparedness is number one. I mean, you got to be prepared, and don't ever just rely on just hope. That's people, anybody who knows me well knows that I hate the word hope because, hope is just not a strategy. That's not, it's, you got to have a plan in motion, and you got to have contingency plan in motion. And then if God forbid something was to happen where a partner walks away, you got to have somebody else as a backup to some extent that you can go to. Does it always work that way? No. Sometimes, unfortunately, sometimes people get hurt in those equations, and they end up losing money. I'm not going to say it never happens. It does happen, but it happens a lot more rarely, I guarantee you, than it's like saying, like, if you drive a car, you're going to get into an accident. Well, are you going to get an accident? I'm like, yeah, that's a possibility. People get into accidents, but do most people get into accidents? No. I mean, probably 98% of the people who drive cars don't get into accidents, but some do.
Yeah, you mentioned, and you did touch on this earlier, the questions and asking them and making sure you're doing your own due diligence from the operator sponsor side of things as well. A lot of times it'll end up being that 12th hour change, or I don't know if the retrade is the right phrase there, but are there questions that a sponsor or operator should ask that maybe you haven't mentioned that will help them kind of prevent those last minute changes on the institutional partner side of things?
Well, you got to make sure. I mean, when you deal with an institutional partner, you're obviously you're going to be presented at some point with a term sheet, or you should be presented with a term sheet, and there should be a mutually agreed upon term sheet that is signed. This is not just a verbal term sheet. This is actually a legal term sheet that the institutional partner presents either via email or via an actual document. And you have to agree, and there's got to be some kind of paper trail or email trail or something about the agreement that's in place with those terms. And once those terms are met, and then you start working towards what is needed for the closing, and you have to also ask a lot of those questions before you even go down that road. You can even front load a lot of those questions before you even get to signing the term sheet. Like, what do you expect? What's your process like? What sort of documents do you need? What steps are you going to take to get us to sort of the closing table? How do you guys work with attorneys? What are your attorneys going to want? Who else do you need to kind of loop in order for this to be to get to the closing table? So if again, it's all about asking all the questions ahead of time before you get to the point where, like, you ask the question and somebody gives you an answer that you don't like, and you're like, shit, I don't like that answer. Well, at that point, you're 10 days from closing, and it's a little bit too late.
You obviously have a lot of experience working with these institutional groups, and you've likely experienced firsthand the pros and cons of bringing them onto a deal. And so I would love to know, what are some of the major advantages and disadvantages of working with institutional groups that maybe you haven't already touched on.
Well, that's the major advantages is that when you find an institutional partner that you can work with and who become a programmatic partner with you, um, it's almost like it's like having a money partner with you, or operating partner with you. I mean, you can at that point, the first transaction is always the hardest. It's always the hardest. The first transaction is takes so much brain damage to do that. Hopefully the second transaction gets easier, and the one after that gets easier, and the one after that. I mean, so once you have an institutional partner on board for one transaction, it's always a lot easier to do this, the other repeat transactions after that. The second thing is obviously the money, the capital. I mean, yeah, you can go out and source your deal through retail investors. You're gonna have to answer to 50 or 60 or 100 retail investors as opposed to one institutional partner. Yes, they may have different demands. Yes, they may have different reporting criteria. Yes, they may be a little bit more picky. Yes, they may be sometimes a pain in the butt to deal with in terms of reporting and and being demanding and having some control provisions and stuff like that. But at the end of the day, you get one check that pays for the majority of your equity. Isn't that value right there? So I can leave it up to. I mean, it depends whether you're a glutton for punishment and want to answer to 100 people as opposed to one person.
It brings to mind the saying "bigger is better," and I know that's not always the case. And in light of the recent changes in the real estate environment with higher interest rates, the occupancy levels changing across the board, and just a lot of the uncertainty in the market, from the perspective of these institutional groups, are they facing any unique challenges or obstacles as they approach real estate investing, specifically from their perspective?
I think their challenges are our challenges. The challenges for institutional groups are the challenges for a lot of sponsors: finding the right deals, finding the right sponsors, finding the right operators. They're experiencing the same thing we are. They're not. I mean, we're all in the same boat together. They may be sitting in a different part of the boat, but we're in the same boat, man. I mean, this just because they're sitting in first class doesn't mean that they're not going to be hit by the same wave as we are. So, I mean, we're all in it together. What the market is doing is affecting all of them, as well as the sponsor out there that is trying to do a deal and close on a deal. So, market conditions is pervasive to everybody, and yeah, I mean, as far as what they're experiencing, it's the same experience as we do every day. They're trying to find the right deals. They're trying to find the right sponsors, and the sponsors themselves are not able to these days. It's very tough to find the right deal that pencil in, but once you do, hold on to it and try to close that transaction. We think there's going to be a whole lot more deals coming in the market that are going to make sense towards end of Q3, Q4 this year, as we see sort of the interest rate a stabilization at some point, and then before we see it, we're not going to see an interest rate retrenchment anytime soon, probably not for another year and a half or 2 years, but we don't need that in order for us to see more velocity of deals. In order for us to see more velocity of deals, people have to have more confident that we have stability in the rate environment, more stability in the capital markets environment, and we're not going to see that until we see sort of a steadfast, stability on some of the rates. And I think we're getting pretty close to that. I think, we might be 3-4 months away from that, but we're getting pretty close to that.
Yeah, to sort of build off that question, have you seen any major shifts in the institutional capital's approach to investing? And are there any new or shifts or trends that you're seeing on that side?
I mean, the shifts there certainly have been shifts in terms of their returns expectations. I mean, the returns expectations have certainly been tampered in the past few months, even since really the beginning of the year. So a lot of institutional investors who may have demanded return expectations in the upper teens are now closer to the mid teens. So it's certainly from a returns expectation perspective, they've gotten tampered because they've gotten more realistic. Like, hey, like, in order for us to do, if we want to do more deals, it's really a matter of volume. A lot of those guys, for a lot of those guys, it's a volume game. They have to put out a certain amount of money in a certain amount of time. And, unless they loosen up the belt on those return expectations, they're starting to realize that they're not going to put out enough money. They're not going to find enough deals, and they're going to be just sitting on a pile of cash. So that goes back to one comment you made earlier, as far as like oh, there's going to be a ton of money sitting on the sideline. Well, the reason there's going to be a ton of money sitting on the sidelines is because that money was greedy as hell in the beginning of the year or end of last year, and they thought that they could get the same return that they used to get back in December, and they're now realizing that, yeah, if I want to put more money out, I need to be a little bit more realistic and more up to date on the market, and the market is just not giving me those kind of return expectations. If I want to, if I want to put out enough money out there. Now, if I don't care, and if I just want to sit it out and just find the right, and just keep digging through the haystack to find that one needle that gives me the right return expectation, that's fine too. But a lot of institutional investors don't have that comfort. They have to put out a certain amount of money at a certain amount of time, especially if they're fund driven. Going back to what I said earlier about sort of your fund mandate, a lot of those institutional investors have certain fund mandates, meaning sometimes they have to be, down to a timing perspective. So, meaning like, by the end of the year, their investment mandate tells them they have to spend $100 million out of their fund, or otherwise otherwise they either get penalized, or they just, it flips over to another year. They create a different tax, and, tax nightmares for them, whatever it might be. So in order for them to put out that $100 million, they got to find deals. And in order for them to find deals, they got to adjust their return expectations in order for them to put out that money.
Yeah, it's funny you mentioned that. I was on an interview yesterday with a different investor, and he was saying, I made the comment on how much capital is on the sidelines, and he expressed the perspective that a lot of times the people with a lot of capital tend to hesitate. In 2008, he was an investor there, and he also said that a lot of that capital stayed on the sidelines even when the market started to dip, because they were waiting for the bottom, and I guess they missed it and weren't able to take advantage of all that opportunity.
I mean, look, the smart investors are the one who just keep looking no matter what the market is doing. The money that loses out are those who stay. Well, who stayed out of the market, who just pulled themselves completely out of the market. And I hear that from everybody. They're like, oh, I'm just going to pull out for the next 6 months. I'm just going to go back in 6 months from now. Well, if you do that, you're not going to find the gems that are going to pop up between now and the next 6 months. So people have always heard me say that, it's not about timing in the market. It's about time in the market. You can't time the market. You can't time the market because even no matter what the market is doing, there's going to be deals out there that are going to make sense. And you have to make sure that you look for them. If you're an institutional investors, obviously, you got to do more than that. You got to be a lot more proactive about actually adjusting your own policies on what you have to expect for returns, your own policies on what you expect for, a perfect scenario, because there's never going to be a perfect scenarios. And I have to sometimes go back to a lot of our institutional guys, when they come up, when we bring them to a deal and say, look, man, you met like 90% of your demands on this deal. It's not going to get any better than that. Like, if you're looking for the 100% perfect scenario, it doesn't exist. You got to be able to compromise on something. So, and maybe pick something that is the least of all evil to compromise on. But if you want to put money out, and if you want to make sure that you're in the market, stays in the market, you got to compromise on something. But you also don't have to. And if you're not driven by anything, if you're not under pressure to put out money, if you're not under pressure to, I hate to say it, make a living, because a lot of us make living by doing deals, and deals are the lifeblood of syndicators, sponsors, operators out there. So there's a lot of hurt and pain out there, because there's a lot of sponsors and syndicators that are not, including us, that are not doing deals, and it's killing us. It's killing a lot of people out there. That the lack of deal, the paucity of actually executing on successful deals, it's hurtful. I mean, it hurts. It's definitely hurt. It hurts the bottom line, because at the end of the day, that's how you keep the lights on, and you got to keep doing deals. But also on the other side of the coin, I don't want to do bad deals. I want to, I refuse to compromise a lot of my expectations, a lot of the safety of my investments, and the safety of my underwriting, and the safety of for my investors, in order for me just to put out money out there, or to just to do a deal. I'm not willing to do that. So there's got to be a balance, is what I'm saying. And I think the balance is just keep looking. the balances keep looking. You'll if you look hard enough and often enough, and it's a numbers game. If you look at enough deals out there, you'll find one that works. It's a lot of brain damage, but and hopefully that brain damage will get lessen and lessen as we get closer to that equalization point that I talked about earlier with the rates, where people start having comfort in bringing more deals to the table. So you start to see more deal velocity, more executions, and I think that's coming. We just have to have enough oxygen to get there. Go to our website, peak15cap.com, or you can find me on LinkedIn, under John Azar. You can email me at azar@peak15cap.com, azar@peak15, peak15cap.com. I'm also on Instagram at JJ Azar. So yeah, any way you can find me.